The United States dollar appears strong on the surface, yet it exists alongside the highest debt burden in American history, a contradiction that has preceded every major currency decline recorded over the past 5 centuries. When economic narratives celebrate resilience while balance sheets quietly deteriorate, history shows that stability is often already eroding beneath the surface. In 2024, the U.S. federal debt surpassed $34 trillion, while interest costs alone exceeded defense spending, a combination that has historically signaled structural stress rather than temporary imbalance. Empires rarely collapse when they first borrow heavily, but when borrowing becomes necessary just to sustain the illusion of normalcy. Reserve currencies do not fail overnight, and they almost never fail during moments of confidence, which is why the most dangerous phase is when markets appear calm and policymakers sound assured. The illusion of safety is strongest just before the underlying monetary framework begins to fracture. Throughout history, governments have always claimed that their debt is manageable, their currency is exceptional, and their situation is fundamentally different from those that collapsed before them. The record shows that these claims are usually made at the exact moment when recovery is no longer mathematically possible. Economic strength is often confused with liquidity. Yet history draws a sharp line between the ability to borrow and the ability to repay without devaluing the currency. When debt growth outpaces real economic output for long enough, the adjustment always arrives through inflation, currency stress, or both. Financial markets frequently rise during late-stage monetary cycles, not because economies are healthier, but because newly created money has fewer productive places left to go. Asset prices inflate while purchasing power quietly erodes, creating the illusion of prosperity as the currency weakens. Central banks are often praised for preventing collapse, yet their most powerful tools historically function by delaying consequences rather than eliminating them. Each delay increases the scale of intervention required later, narrowing the path to genuine recovery. The dollar's dominance has insulated the United States from immediate consequences. But insulation is not immunity, and reserve status has never been permanent in recorded economic history. Every prior reserve currency declined not because it lost relevance, but because it was overused. Confidence, not gold or oil or military power, is the true foundation of a global currency system. Once confidence begins to depend on constant intervention, the system has already entered its most fragile stage. This documentary does not argue that the dollar will suddenly collapse, because history shows collapse is rarely sudden and almost never obvious. It asks a more dangerous question. And what happens when the world's most important currency can no longer recover in the way it always has before? Money in modern economies is not a fixed object, but a promise, created through lending and sustained by confidence that the promise can be honored in the future. When governments spend more than they collect, that promise expands, and the value of each unit of currency quietly depends on the belief that the system remains under control. Sovereign debt cycles follow a predictable structure in which borrowing initially accelerates growth, stabilizes crises, and delays political trade-offs. Over time, however, debt stops funding productivity and begins funding survival, marking a shift from expansion to dependency. Governments finance persistent deficits by issuing bonds, which transfer today's obligations into the future and rely on continued demand from investors. When private demand weakens, central banks step in, transforming government debt into newly created money. This process does not immediately cause inflation because excess liquidity often remains trapped within financial systems. History shows inflation usually arrives later, once confidence weakens, and money begins chasing fewer real goods. Interest rates are used to manage this balance, rising to control inflation and falling to stimulate borrowing. Yet every long-term debt cycle reaches a point where rates can no longer rise without breaking the system they are meant to protect. At that stage, policy choices narrow dramatically, forcing central banks to choose between currency stability and financial stability. Repeatedly, history shows financial stability is chosen, even at the expense of long-term currency value. Reserve currency status delays this reckoning by exporting excess currency abroad through trade and capital markets. Foreign governments and institutions absorb the surplus, allowing the issuing nation to live beyond its productive capacity. However, this privilege creates its own vulnerability because it depends entirely on sustained global confidence. Once alternative settlement systems emerge, or geopolitical trust erodes, demand for the reserve currency weakens. Credit expansion plays a critical role in masking structural weakness during this phase. Easy credit sustains consumption and asset prices even as real wages stagnate and productive investment slows. Over time, economies become increasingly sensitive to debt servicing costs rather than innovation or productivity growth. Small changes in interest rates begin to produce outsized financial stress. This fragility is often misunderstood as temporary instability rather than a systemic condition. Policymakers respond with more intervention, reinforcing the very dynamics causing the strain. Historical records from multiple empires show that monetary systems rarely collapse because of a single policy mistake. They fail because repeated short-term fixes accumulate into long-term structural damage. Inflation, in this framework, is not an accident, but a release valve. It reduces the real value of debt while transferring costs quietly to currency holders. Currency stress follows when inflation undermines confidence faster than policy can restore it. At that point, trust becomes conditional rather than automatic. This repeating pattern forms the backbone of every major monetary decline in recorded history. Understanding it is essential before examining any specific collapse or modern parallel. At the start of the 20th century, the British pound sterling was the world's dominant reserve currency, anchoring global trade and finance through the gold standard. Britain's economic power rested not only on industry, but on trust that its debts were limited and its currency stable. That trust began to fracture in 1914 when World War I forced Britain to suspend the gold standard to finance unprecedented military spending. Government debt exploded as borrowing replaced taxation, marking the first major break in Britain's long-standing monetary discipline. By 1918, Britain's national debt had increased more than tenfold compared to pre-war levels, fundamentally altering its fiscal structure. Although the war ended, the debt remained, locking the economy into decades of financial strain. In 1925, Britain attempted to restore the pound to its pre-war gold parity, believing credibility could be reclaimed through policy declaration alone. The decision overvalued the currency, weakened exports, and forced domestic deflation that damaged growth and employment. Economic pressure intensified during the Great Depression as global trade collapsed and capital fled toward perceived safety. In 1931, Britain abandoned the gold standard permanently, admitting that the pound could no longer support its former role. World War II delivered the final blow to sterling's dominance, as Britain financed survival through massive borrowing from abroad, particularly the United States. By 1945, the nation emerged victorious militarily but financially exhausted. The Bretton Woods system formalized this shift, placing the US dollar at the center of global finance while relegating the pound to a secondary role. Britain retained influence, but no longer controlled the monetary system it once dominated. From 1945 to the 1960s, Britain struggled with persistent trade deficits, slow growth, and repeated balance of payments crises. Maintaining the pound's value required constant intervention and international assistance. In 1967, the British government officially devalued the pound by 14%, acknowledging what markets had already priced in. The announcement confirmed that confidence had been lost gradually, not suddenly. Each policy response focused on preserving stability in the short term rather than restoring long-term competitiveness. Currency controls, borrowing, and monetary easing postponed adjustment while weakening credibility further. By the early 1970s, inflation accelerated as monetary expansion outpaced productivity growth. Rising prices eroded purchasing power, reinforcing the pound's decline on the global stage. In 1976, Britain was forced to seek assistance from the International Monetary Fund, an extraordinary step for a former reserve currency issuer. The IMF bailout imposed fiscal discipline that domestic policy had avoided for decades. Sterling did not collapse into worthlessness, but it never regained its former status or influence. Its decline unfolded over more than 60 years, hidden behind temporary recoveries and policy reassurances. The British case demonstrates that reserve currencies rarely fall through chaos alone. They fade through debt accumulation, policy trade-offs, and the slow erosion of confidence. At no point did policymakers announce the end of the pound's dominance. History marked that end only in hindsight, once the transition was complete. Britain's experience reveals that monetary power is not lost through a single mistake, but through repeated compromises made under pressure. Each compromise seemed reasonable at the time, yet irreversible in total. The lesson is not that Britain failed uniquely, but that it followed a familiar path. Monetary leadership carries privileges that, when overused, quietly transform into liabilities. This historical pattern provides a framework for examining modern systems without relying on speculation. It shows how debt, policy, and confidence interact over decades, not months. Understanding this case is essential before evaluating today's global financial structure. Only by recognizing the pattern can meaningful parallels be drawn. In 2008, the United States responded to the global financial crisis by expanding public debt and deploying unprecedented central bank intervention to stabilize the system. What was presented as an emergency measure became the foundation of a new monetary normal. Federal debt rose from roughly $9 trillion in 2007 to over $16 trillion by 2012, even as interest rates were pushed toward zero. Low rates reduced immediate stress, but encouraged deeper reliance on borrowing across the economy. Quantitative easing transformed the Federal Reserve into the largest buyer of government debt, expanding its balance sheet from under $900 billion to more than $4 trillion within a few years. This policy stabilized markets, but blurred the line between monetary management and fiscal financing. Economic growth returned unevenly, while asset prices surged far faster than wages or productivity. The gap between financial markets and the real economy widened, masking underlying fragility. When the COVID-19 crisis struck in 2020, the response accelerated these trends rather than reversing them. Trillions in new spending were financed through borrowing, while central bank asset purchases reached historic scale. Between 2020 and 2022, the U.S. money supply expanded at the fastest pace since World War II. Inflation did not appear immediately, reinforcing confidence that the system remained under control. By 2022, consumer inflation exceeded 9%, the highest level in 4 decades, forcing a sharp shift in monetary policy. Interest rates rose rapidly, exposing how dependent the system had become on cheap credit. Higher rates increased debt servicing costs across government, corporations, and households. The federal government's interest expense alone climbed toward levels unseen outside major wars. Banking stress emerged as asset values adjusted to higher rates, revealing hidden vulnerabilities. Several institutions failed not because of poor management alone, but because long-term assets were incompatible with a new rate environment. Foreign holders of U.S. debt began reassessing exposure as returns adjusted for inflation weakened. While demand remained strong, its composition shifted toward shorter maturities and higher compensation. Geopolitical tensions further complicated the landscape, as trade disputes and sanctions altered global payment flows. Alternative settlement mechanisms gained attention, not as replacements, but as risk management tools. The dollar remained dominant, yet dominance required increasing intervention to maintain stability. Each intervention reinforced dependence on policy rather than productivity. Unlike earlier decades, demographic trends and slower growth limited the economy's ability to outgrow its debt. Productivity gains failed to offset the scale of accumulated obligations. Fiscal policy faced structural constraints, as spending cuts risked recession while continued borrowing raised long-term credibility concerns. Political cycles favored postponement rather than resolution. Monetary policy encountered similar limits, as aggressive tightening threatened financial stability while easing risked renewed inflation. The policy space that once enabled recovery narrowed significantly. Global investors began treating U.S. assets less as unquestioned anchors and more as relative choices. Confidence became conditional rather than assumed. The United States did not face imminent currency failure. It faced something more complex, a slow erosion of policy flexibility. Recovery narratives persisted because decline did not resemble crisis. Stability remained visible even as structural limits tightened. This environment mirrored late-stage monetary cycles documented throughout history. Strength remained real, but increasingly expensive to sustain. The question shifted from whether the system worked to how long it could function under growing strain. History suggests this phase lasts longer than expected, but ends the same way. Understanding where the system stands today requires abandoning short-term comparisons. The pattern unfolds across decades, not quarters. The modern application is not a prediction, but a contextual alignment with historical precedent. The mechanisms at work are familiar, even if the scale is unprecedented. If current patterns persist, the most immediate consequence will not be collapse, but gradual pressure on purchasing power. Inflation becomes less dramatic, yet more persistent, quietly reshaping living standards over time. As debt servicing consumes a larger share of government revenue, fiscal flexibility continues to shrink. Resources shift from productive investment toward maintaining existing obligations. Higher interest rates, even when moderate, compound stress across financial systems built on cheap credit. Banking institutions become more fragile as asset values fluctuate against fixed liabilities. Governments facing rising costs encounter difficult trade-offs between taxation, spending cuts, and further borrowing. Each option carries economic and social consequences that limit political willingness to act. Currency stability increasingly relies on credibility rather than fundamentals alone. Once credibility weakens, restoring it requires greater sacrifice than maintaining it ever did. Global trade adjusts as exchange rate volatility influences pricing and settlement choices. Businesses respond by diversifying exposure rather than committing fully to any single currency system. Reserve currency transitions rarely involve abandonment. They unfold through gradual redistribution of functions across multiple instruments and regions. As alternatives absorb marginal demand, dominance erodes without disappearing. This diffusion reduces shock risk but increases long-term uncertainty. Living standards decline not through sudden poverty, but through slower growth and rising costs. the adjustment feels subtle until measured over decades. Public expectations lag behind economic reality, delaying behavioral change. Consumption patterns adjust only after purchasing power has already eroded. Financial repression becomes more likely as governments seek to manage debt sustainably. Savings yield less in real terms, transferring value to borrowers. Capital controls, whether explicit or implicit, emerge as tools of stability. They function quietly, framed as regulatory safeguards rather than restrictions. Political narratives emphasize resilience and recovery. These narratives coexist with policies that acknowledge structural limits. International relations increasingly reflect financial considerations. Currency influence becomes a component of geopolitical strategy. Markets price risk incrementally rather than catastrophically. Volatility replaces panic as the dominant signal. The system remains functional but less forgiving. Small shocks produce larger responses. Over time, adaptation replaces optimization. Economic actors prioritize durability over growth. Innovation continues, but under constraint. Productivity gains struggle to offset accumulated obligations. This phase is often mistaken for stagnation rather than transition. History recognizes it as neither temporary nor terminal. Outcomes depend less on single decisions than on cumulative choices. Each year of delay narrows future options. The longer adjustment is postponed, the more adjustment concentrates in fewer channels. Inflation and currency stress absorb pressure avoided elsewhere. Economic history shows no painless resolution at this stage. Costs are paid either openly or quietly. The implications are structural, not cyclical. Traditional recoveries do not reset the system. What follows is not predetermined, but constrained. Policy choices operate within shrinking boundaries. This reality reframes how success and stability are measured. Growth rates matter less than resilience. Understanding these implications requires abandoning expectations shaped by earlier cycles. The system has entered a different phase. History does not punish debt immediately. It waits until adaptation becomes unavoidable. The question is not whether consequences arrive. It is how they distribute across society and time. This distribution defines the lived experience of monetary transition. It unfolds slowly enough to be normalized. Recognizing this process is essential to interpreting what comes next. Without recognition, adjustment feels unexpected.